Ever wondered what happens when a country's imports exceed its exports, or vice versa? This scenario paints a picture of what we call a disequilibrium in the balance of payments. Now you might be asking, what is the balance of payments? In simple terms, it's a record of all economic transactions between the residents of a country and the rest of the world in a given period. It's like a country's financial report card, showing its economic interactions with other nations. The balance of payments is significant because it helps us understand a country's economic health and future prospects. But what happens when there's a disequilibrium? That's when the money flowing in doesn't match the money flowing out, and it can lead to some serious economic challenges. The balance of payments consists of three key components: the current account, the financial account, and the capital account. Each of these plays a unique role in a country's economic interactions. Understanding these components is essential to grasp how policies can correct a disequilibrium. Let's dive in. First, the current account. It records a country's transactions related to goods, services, income, and current transfers. This account is like a ledger that keeps track of all the trading activity a country conducts with the rest of the world. It includes the export and import of goods, such as cars, electronics, and oil, services like tourism or financial services, and income flows from investments and wages. Current transfers, such as remittances sent by individuals working abroad to their home countries, also find their place in the current account. Now let's move on to the financial account. If the current account is all about trading, the financial account is all about investing. It records investment inflows and outflows into and out of a country. This includes foreign direct investment, where companies invest in businesses in other countries, and portfolio investment, where individuals or institutions invest in foreign stocks, bonds, or other financial assets. It also includes other investments like cross-border loans, currency deposits, and bank reserves. Finally, we have the capital account. This account documents capital transfers and the acquisition or disposal of non-produced, non-financial assets. Capital transfers include debt forgiveness and migrants transfers, which are the funds that immigrants bring into a country when they move there. Non-produced, non-financial assets refer to things like patents, copyrights, and franchises, which can be bought and sold between countries. Each of these accounts plays a crucial role in a country's balance of payments. They provide a comprehensive picture of a country's economic interactions with the rest of the world, from buying and selling goods and services to investments and transfers. But what happens when these accounts don't balance out? What if a country is spending more than it's earning, or earning more than it's spending? So what happens when there's an imbalance in these accounts? Let's explore. A country can employ fiscal, monetary, supply-side, protectionist, and exchange rate policies to correct a balance of payments disequilibrium. Let's break this down. Fiscal policies involve government spending and taxation. For instance, the government can boost domestic production by increasing spending on infrastructure or by lowering taxes to stimulate consumer spending. These actions can reduce imports, improving the current account balance. Monetary policies, on the other hand, involve controlling the money supply and interest rates. A central bank might raise interest rates to attract foreign investment, which can bolster the financial account. However, higher interest rates often dampen domestic spending, which can have a knock-on effect on the current account. Supply-side policies focus on making an economy more productive. These might involve measures to enhance education and training, boost research and development, or improve infrastructure. By boosting competitiveness, these policies can enhance exports and reduce reliance on imports. Protectionist policies refer to trade barriers, like tariffs and quotas, designed to shield domestic industries from foreign competition. These can reduce imports, thereby improving the current account balance. But remember, these policies can trigger retaliation from trade partners and potentially harm global trade. Exchange rate policies involve managing the value of a nation's currency. A country could devalue its currency to make its exports cheaper and imports more expensive. This could improve the balance of payments by boosting exports and reducing imports. Now let's touch on expenditure-switching and expenditure-reducing policies. Expenditure-switching policies aim to alter the composition of expenditure from foreign to domestically produced goods and services. This is often achieved through devaluation. Expenditure-reducing policies, on the other hand, aim to decrease overall demand in the economy, often via fiscal or monetary measures. These policies can also influence exchange rates, another key factor in international economics. As we delve deeper into the world of international economics, we'll see how these policies and rates intertwine to shape the global economy. Now, what exactly are exchange rates and why are they so important in international economics? Exchange rates, in the simplest terms, are the price of one country's currency in terms of another. They form an integral part of global trade and economics, influencing everything from the price of your morning coffee to the cost of an international holiday. Let's delve a bit deeper to understand two key types of exchange rates: nominal and real. The nominal exchange rate is the rate at which you can exchange one currency for another. For instance, if you can exchange $1 for 75 Indian rupees, that's the nominal exchange rate. On the other hand, the real exchange rate adjusts the nominal rate to account for differences in price levels between countries. It gives us a more accurate picture of a currency's true purchasing power. Think of it this way. If a cup of coffee costs $5 in New York and 300 rupees in Mumbai, the real exchange rate would be 60 rupees to the dollar, not 75. Next up, we have trade-weighted exchange rates. This is a complex average of a country's currency exchange rates with its trading partners, weighted by the trade that happens with each. It's like a batting average for a country's currency, giving us a more comprehensive picture of its international economic performance. Now, how are these exchange rates determined? Under a fixed system, the government or central bank sets the exchange rate and intervenes to maintain it. In a managed system, the exchange rate is allowed to fluctuate within a certain range, with the central bank stepping in if it veers too far off course. Finally, let's touch on revaluation and devaluation of a fixed exchange rate. Revaluation is when a currency's value is increased relative to other currencies, usually to control inflation. Devaluation, on the other hand, is a deliberate downward adjustment of a currency's value, often used to boost exports. But what happens when these exchange rates change? Well, that's a topic for our next scene, so stay tuned. Changes in exchange rates can have significant effects on a country's external economy. Indeed, the dance of numbers in the world of exchange rates can cause a ripple effect that reaches far and wide. To help us understand this better, let's explore the Marshall-Lerner condition and the J-curve analysis. The Marshall-Lerner condition is a theory in international economics that states that a devaluation or depreciation of a country's currency can improve its balance of trade, but only if the sum of the price elasticity of exports and imports is greater than 1. In simpler terms, it means that if a currency becomes weaker, it can lead to a surplus in the balance of trade if the demand for exports and imports is responsive enough to changes in price. Now, imagine a scenario where the US dollar depreciates against the euro. American goods become cheaper for European consumers, potentially leading to an increase in demand for American exports. At the same time, European goods become more expensive for American consumers, possibly leading to a decrease in American imports from Europe. If the increase in exports and decrease in imports is large enough, the US could see an improvement in its balance of trade. Now, let's talk about the J-curve effect. The J-curve is a theory that suggests that a country's trade deficit will initially worsen after its currency depreciates because higher prices on foreign imports will be greater than the reduced volume of imports. However, over time, as the volume of exports rises and the volume of imports falls, the trade balance will improve. It's called the J-curve because if you were to graph it, the shape would resemble the letter J. So, applying the J-curve to our earlier example, we might initially see the US trade deficit with Europe increase due to the higher cost of European imports. But over time, as American exports to Europe increase and imports from Europe decrease, the US trade deficit should theoretically improve. These changes can also influence the balance of payments, bringing us full circle back to our original discussion. So as we can see, the world of exchange rates is a complex and fascinating one, with far-reaching effects on the global economy. So, we've taken a whirlwind tour of international economic issues related to the balance of payments and exchange rates. We've broken down the components of the balance of payments, diving into the current account, financial account, and capital account. We've also delved into the policies designed to rectify imbalances, ranging from fiscal, monetary, and supply-side strategies to protectionist and exchange rate policies. We then shifted our focus to the fascinating world of exchange rates, distinguishing between nominal and real rates, and trade-weighted exchange rates. We've discussed the determination of exchange rates in fixed and managed systems, and differentiated between revaluation and devaluation of a fixed exchange rate, We also explored how changes in exchange rates impact the external economy using the Marshall-Lerner and J curve analysis. Remember, understanding these concepts is key to comprehending the complex world of international economics. Until next time, keep exploring and learning.